All right, hello and welcome everybody to Advisor.Investments. Maybe it's a podcast, maybe it's a non-podcast podcast, but this is our first attempt at this. And today I have Shane Haig.
We got a computer glitch, James. There we go.
Well, that's the way to start this thing off. I'm James Pope. We have Shane Haig and Reggie McFadden, counterclockwise there, at least on my screen. So today, in the initial podcast, we want to start with a focus on the investments side. You know, we also do, tax analysis, look at wealth management, kind of retirement type issues. But today we want to focus just on the investments. And if y'all say nice things, maybe we could get some other people on here. They won't be afraid to join us. But first of all, anything y'all want to start off with? I'll kind of save my questions, see if y'all want to introduce yourself or anything like that.
No, I'm just excited to start this. We'll see what happens and see if the clients like it, but just want to appreciate you having me on here. May enlighten some people about some markets.
Yeah, I think in light of the challenges we have with the pandemic and our ability to do the client appreciation luncheons this year again, maybe this will be something that's helpful and might be able to get to everybody too, regardless of location. So let's get it started.
Yeah, I think that's a great point. Well, yeah, I'll start. One of our main themes, there's so much gray lines between speculation, gambling, and investing. And over the years, I know we've kind of found where we feel like our strengths are, in accounting and investment analysis, and actually where our weaknesses are is, kind of predicting where the market's going to go. Luckily, we read enough investment quotes from Warren Buffett, and he says things like, well, in reality, if you're going to be an investor, predicting where the market's going to go is unnecessary and probably harmful. So I'd like to just start right there and see, Shane, meeting with clients, it's a speculation environment right now. So do you have any tips kind of to keep our mind focused on the investments?
Wow, that's a big one. I try to quite often, almost in every conversation, to remind everybody what we're really focusing on is actually just trying to be the investor as opposed to the speculator or the gambler or the trader even. So my example, I guess, would be, I'll just go right to my kids' example. They're saying, "Dad, why don't you buy Dogecoin for your clients?" Because one of them put in $500 and it went to 800 or something. And so I'm trying to say, hey, wait a minute. We are a fiduciary. We are working with a lot of people's retirement, entire retirement assets that are in their 50s, 60s, 70s, and 80s, not somebody who's 22 who doesn't matter if they lose $500. And so there's a big, big difference between gambling on certain things that are popular or in our culture we're hearing about. And the truth is, when I ask them what it is, even my kids can't really explain it. So I try to let them know sometimes it's okay to be boring. If we stick to our core competency here, which we've learned to do, and not try to be a jack of all trades, master of none, we end up doing a lot better, and our clients ended up doing a lot better. That's what's going through my mind anyways right now.
All right. Well, I know Reggie has a CFA, and A stands for Analyst. So I was wondering if you could kind of explain the difference, what really separates somebody from speculating, and then what you do as investment analysts.
Right. It's, as far as speculating, and that's all based on price and price only. Just people watch the prices and this is going up, so it's good, and I got to get in before it goes up more, or instead of actually looking at the business, the investment as and analyzing, what the real value is. And back to Shane's point on the cryptocurrency, et cetera, there's really no analysis to be done other than if the price is going up or down. I mean, there's no cash flows. The technology, I think, is probably something that is useful, but for me to make a guess on anything like that would just be pure speculating back to it, or gambling that the price is going higher.
All right.
Yeah.
Well, I'll kind of change the subject here, because one of the things I hear a lot from clients, read a lot on the news, and even that gets into that speculation part, but I know is also part of your analysis is, what are the interest rates? And what we can see, at least in the short term, and Treasury, Fed type people tell us it's just transitionary inflation. But what should really concern us about how low interest rates are right now? Shane, maybe from your meeting with clients, the questions that are being asked, and how does this affect their spending?
Well, I don't know. I think sometimes people look at financing something and they're looking at the monthly amount that it costs to buy it, not the value of the item or the true cost over the long term. And that's many of the problems when you have low interest rates and the asset bubble inflates and people end up eventually biting off more than they can chew, I think is the analogy. And so I think just people having to be mindful and very careful of that, because those asset prices can come right back down and the value isn't there for what you paid for. That's something I see maybe in the real estate market quite a bit right now.
Right.
I think the question I get, maybe, and Reggie can answer this much better, I think, is that interest rates are so low and that yield curve is almost flat. You don't get much more when you go out 1 year, 5 years, 6 years, 8 years. And so one of the questions I think most people say is, hey, we got a lot of money, and it's usually in the Schwab money market right now. When interest rates start going up, would you guys do something differently? And I said, yeah, that would probably change the dynamics quite a bit. Reggie can probably elaborate more than I can there.
Yeah, it's tough, and I guess trying to circle back around on the question of well, the stock market's high, but interest rates are so low that what am I really supposed to do? And so that with the interest rates where they are, I mean, for a 5-year CD, even a 5-year single A rated bond, you're talking about 1%. And while the Fed says it's transitory, that inflation is real, and trying to go out there for 5 years just for 1%, even the Fed's telling you they're going to try to, even if it is transitory, they're going to try to keep it at 2% or above. And so going out there right now at 1% just makes no sense. So hopefully we do get some rise in rates and can ladder out the CDs, but currently it's just not worth the risk.
Yep.
Well, that's interesting. You bring up 1%-ish for 5 years. I know, Shane, a lot of the press on the financial side goes to, hey man, you can withdraw 4%. I mean, you still in that camp, or what's the updates on that?
Well, I think when those studies are talking about, they're talking about over a 30-year period. And so we're encountering a period of time right now where the interest rates are really low, but that doesn't necessarily change my view on that withdrawal rate. I think 4% is still very reasonable for most people. And it all depends individually, really. It depends on their debt and everything else that goes into it. But I think the biggest problem is that some of those old studies assume that you were going to have much, much more cash than you really want to nowadays, and when the value is not there. So the devil's in the details to me, but when you really get inside of it, it really doesn't make a lot of sense to have excess cash when you break it down in terms of one's own personal year's worth of living expenses, that is. And I think that's really where you got to individualize it, and there's no one rule of thumb that applies to everybody. Right now, that's probably the bigger issue, I think, is having too much there when it's a non-productive asset. Well, let me take that back. I'll say non-productive, but 3 ways I think it's actually very productive is it represents your withdrawals. So the cash is exceptionally important in that case. The other thing it does is it represents opportunity money when things do change, and I think that's super helpful too. And then the third thing would probably be the ability for us to, boy, it just jumped right out in it. So I'll have to turn it back to you for a second.
Were you talking about opportunity cash or?
Yeah, I was thinking opportunity cash, withdrawals, and then, boy, that's what happens when you go live. Sometimes things don't work out as perfectly as you'd like it to.
Well, sometimes to me, it just adds a level of comfort knowing that the investment will go up and down and allow you to stick to your plan.
Right, your individual allocation and risk tolerance is what I meant. So everybody, you can stick with it when you know what you got.
All right, well, y'all brought this up earlier, but I see a lot and I hear a lot, and I think they even have indexes. I'm seeing you have the S&P 500, the Dow Jones, and then you have Bitcoin. So Reggie, I mean, from an analyst perspective, how do you analyze a cryptocurrency? I mean, what are your thoughts on that?
Well, geez, I do get asked a lot about it just because prices are going up, but the toughest thing about being in this business is the expectation to know everything about everything. And right now it's new, and the level of competency for me understanding Bitcoin and the 7 million different coins out there, the Doge coin, the sushi swap coin, the who knows what it is, but it seems like they're always creating these new different coins, and I just don't understand enough about it to actually invest somebody else's capital in it. It's a very uneasy feeling when you don't know anything about it.
Well, yeah, I know, one quote we talk about a lot, Warren Buffett, is, as long as you can avoid doing dumb things, you don't have to be really smart about everything if you stay in that circle of competence. So over the years, I've learned that more and more, and you start to find out what your own personal circle of competence is. But, Shane, I mean, as far as when you're talking with people, there's a fear of missing out. I mean, it's real. You feel that. I think it's just human. How do we kind of process that in our mind to keep us focused on investing instead of something that can't be analyzed, and you just hope there's a greater fool out there who comes after you and gives you some liquidity?
Well, I hope that we do a good job as a company engaging with our clients in this form or individual meetings, trying to remind them of those things and our own humbleness of being only be able to do so much. I think there's that fear of missing out. Maybe we said it earlier, but my real life story was, my kids, I think I said, invested in some of that, right? And there was this big thing. Elon Musk is on, and everyone else knows that, right? So my wife knows they did that. And Elon Musk was on Saturday Night Live, and that's when, look, you got to get in there before then. It's going to go crazy, right? So that was maybe 50, 55 cents a share, James. And so the truth of the matter is Doge is at 22 cents a share now, okay? And that was a couple months ago. So not everybody made money, but what everybody remembers is the neighbor, their friend, or their son who said, I doubled my money. My 500 went to 1,000, which sounds great. And you feel like you should be a part of that. But the reality is 3 months later, there's not a double, actually. It's dropped 50%. And anybody who was encouraged to jump in before Elon got on Saturday Night Live didn't work out really well for him. So I think in our social media culture and a lot of advertising, there's a lot of hype. But at the end of the day, there'll probably be more people hurt than helped. There might be a structure for these tools in the future that look different than they are today. I'm not saying that's not possible, but the hype and the mania around all these different things, if you can tune that out, focus on what's important, and I think that's what we're doing a good job here and sharing with our clients that we're trying to continue to do for them.
Right, and even if you do quote unquote miss out, you know, it's something that is not needed to be successful in investments. I mean, there's many other things out there, and you know, it's not getting on the next coin is not going to determine your success, you know, longer term.
Right. There's thousands of securities out there, so every day we're missing out on something that went crazy we know nothing about. So that's just actually keeping your eye off the ball, actually. And if we focus on our core competency, which you guys are doing, I know, our clients got a much better chance of doing well.
That brings me to the next point. I see, you know, U.S. stock market's at all-time highs, and I think question I kind of get mostly in some format, if I get down to the core of it, it's something like this. Is this a deserved market, or is this just hype? Is the economy really doing that well? I'll leave it to Reggie first.
Well, you know, from an economic standpoint, you know, you are seeing growth in GDP, and the idea that the Fed quits buying all these assets and actually lets interest rates rise, you know, eventually that will lead to a slowdown of the economy, just from a natural standpoint of how interest rates affect the economy. Going back to Shane and talking about the assets based on the interest rates and what you pay for a house. And so those rates start to creep up. And of course, you know, people then look at the same house as gonna, you know, might be a lower price. So right now the economy is churning along, but the fear is that the interest rates could slow it down in the near term or even further out. So that's kind of where you're in a catch-22 with you got the stock market where it is, you got interest rates where they are. It's kind of right now a tough investing environment. And so what we just try to do is go in there and find maybe where there are opportunities. Maybe it's commodities with the inflation, and you find companies that are able to pass along those costs.
All right. Well, Shane, I know with market near all-time highs, maybe it's pulled back a little bit here last couple of days or so, but the last month. But it brings up both points, because as a client, if I'm not in this every day, I either have, depending on my current allocation, a fear of missing out, that I already missed out. Maybe I need to jump in. Or I'm on the other side and I said, man, I've been riding this for a long time. This is too good to be true. I need to go all cash. I mean, what's your suggestion kind of to both of those?
Well, my suggestion to both of those would be that you first start with your need for liquidity, and you base your things around that. And then you work your way into what the right allocation is for you. So in our case, we're going to say, I want you to have at least 3 years of planned withdrawals if you're a retiree. If you're just a 25-year-old, get your allocation correct within your risk tolerance. But if you've got 4 or 5 years worth of withdrawals, then that money can be eligible for investments. Then you've got to decide if you're doing it yourself or if you're using us, where, as you know, we will then try to be good stewards of that money and allocate that properly. I think it probably relates to how we have our top 6 ideas, or what you say, managing our favorites, and how you go about identifying what you do, because we don't just throw it into the market. and we don't ask somebody to try to time the market by just selling everything and getting out of it. I would pick an allocation based on your own personal criteria that fits, and then turn it over to the investments and expect poor times. And over the next 10 years, we're going to have some good years and some bad years, James. We just don't know when the sequence of events is. The important thing is that we have the account that's set up properly for the liquidity needs, and so that we have that opportunity. I would have guessed we would have had a bad market 3 or 4 years ago, and if we used my gut, we'd have never been in the market. We would have missed this whole thing. So trying to invest that way doesn't really work, but doing it individually based on your allocation, your liquidity needs, and then our investment approach is something that I think most people will do well if they just stick to it. Try not to get too brilliant.
Right, what you just said, I catch myself saying all the time, and then what I forget about, we haven't been up for 3 or 4 years. There was a serious market pullback in March of 2020, and I catch myself saying that all the time, and really going longer than that, say, hey, in 9 years, we haven't had a pullback. But it was so quick, and I think all of our mentality nowadays on that fear of missing out, we tend to forget that it wasn't that long ago that there was pure panic in the U.S. market, and it comes around quick. It was just over so quick that we can glaze over that. But you definitely need to keep that cash in there because a lot of corrections or crashes or pullbacks don't recover as quick as that one that we just had. That was pretty amazing there. But both of y'all kind of touched on this topic, and I'll let it be the last. So kind of a catch-all as well as the last one is if there's anything really that you want to say and get out there today. But on Reggie's side, it'll be, hey, is there, an area of interest in the investing, with the current market, and then even from Shane's standpoint, I know he don't dig into the details of the businesses, but really, is there that one core idea that you would like to generically over the mass basis be able to share with clients? Sometimes it's even, those one-to-one meetings and it's kind of personal, and you get talking about other things and people's family and things like that. But really that most important thing, that you could share with nowadays. And I'll start with Reggie, one of your areas of interest in the investing world.
Well, I think, back to just the markets. And I think a lot of people have probably lost more money trying to call bear markets or miss out on the pullbacks instead of stepping back and analyzing the investment and the business. And that kind of leads me to, one of the investments we like now is just Cal-Maine. They're the largest egg producer in the United States. And, so inflation is, the egg prices are at, lower points in the cycle. And that if there is food inflation, which I know everybody sees now, but that it is just a well-run business with no debt, the largest egg producer in the United States. And so if inflation feeds into the egg prices, they will be a sole beneficiary of it.
All right. And I guess on to you, Shane.
Well, now I got to remember what you questioned.
I think you said it probably a bunch of times so far, but
having this been our first podcast, so to speak, I can't remember what I've said 20 minutes ago, but honestly, a lot of my meetings, we look at everything and we want to make sure that their allocation is balanced. And then we really just look at making sure that they've got enough years worth of planned withdrawals so that they can remain an investor. And for me, you know, we say, hey, I'm glad you didn't jump off a bridge in March. That wouldn't have helped. And don't go out and buy a boat just because things have been really good lately too. You know what I mean? Try to have a balanced approach to what we're doing. And that's when we say think long-term, not because everyone has exponential life expectancy, but we're talking long-term through business cycles on some of our investments. Expect some of the things, you know, when you've got a garden full of plants, not everything is in full bloom every time, you know what I mean? So when you look at your portfolio, if we're diversified, not everything should be up at the same time. You might have some things that aren't, and that's fine. Expect that. That's a natural process. And that's usually what it's about, is just understanding our process. And because I didn't write it, James, and you did, I really always go to our annual review. It's 15 pages. My mom probably deleted it right away. But those who would take the time to actually read that, I think it goes a long way for them to be able to understand, hey, I understand exactly what these guys are doing in the approach. And hopefully they can say, you know what, that really represents me and how I feel too. And so then we report back to you. And we're trying to get better in communication. And this is our first attempt at also doing something differently. So hopefully we're doing it.
Well, all right. I agree. You know, to my overall important aspect is the investment environment that we're trying to create through communications like this. If we go to the 35,000 foot view, what we are emphasizing is business analysis. Most of the popular questions and media aspects are around, you know, predicting where the price will be, where you're talking to what Reggie just talked about is how big of a moat does Cal-Maine have? How are their CEOs? How's their management team focused on? And all of those aspects are really very different from what's popular. So I thank both of y'all, because I think it contributes to that investment environment and keeping our clients focused on the investments. And, you know, sometimes I get into meetings and, you know, I'll hear those words back to me. So it keeps us focused when we're actually doing analysis and research as well, and keeps us from getting out on that ledge, that gray area of investment speculation and gambling. So that's it from me. I appreciate everybody's time. And if you got feedback, we'd love to hear it. So that's an ending. See y'all later.
All right. Thank y'all. Take care.